So is this income strategy capital efficient? Absolutely. But also, did the downside risk exposure for this strategy come back to bite me in the... What's up, you guys? Welcome back to the Average Joe Investor channel. Today we're talking about the YieldMax style IWM trade that I put on at the end of January 2025. With, of course, the goal of creating income, but also being extremely capital efficient. Well, I just recently closed out that trade and the results were not exactly what I hoped for. In this video, I'm gonna break down for you exactly what this strategy entailed, what the actual results were, and also what were my key takeaways. This channel is all about transparency and testing lots of different strategies. So let's talk about this strategy and the specific details that led to it not being such a great idea. Before we can really debrief what happened with this trade and what lessons I learned as a result, we need to understand how it was set up, what the actual strategy was, and then we'll go over those specific details of my trade. So the YieldMax style strategy for income purposes is based off of a traditional covered call strategy. In a traditional covered call strategy, we'd have 100 shares owned of a stock or ETF, and then once you own those shares, then you sell call options. And this is considered a covered call because if and when you get assigned on your call option, your position is covered because you already own the shares. There's no risk of having to go out and buy the shares to then give to somebody else if you get assigned. Now, the normal way of doing a synthetic approach to this, or not owning 100 shares, would be if you were to purchase a call option that is deep in the money, meaning with a strike price far below the current market price, and that expires way out into the future, known as a leaps contract, so generally a year plus expiration from now. The YieldMax style is a variation of this strategy where instead of just purchasing one deep in the money call option, instead they create a synthetic long exposure by, number one, purchasing a call option at the current market price or at the money, and at the same time selling an at the money put option. Because you own a call option, meaning unlimited upside exposure, and you now have sold an at the money put option, unlimited downside exposure, you're creating the same type of synthetic long exposure to a regular stock, which can go up or down based on the actual share price. The big benefit to this strategy is that sold put option pays for the majority of the cost of the call option, so the amount of net capital you have in the trade is very low. Let's look at an example. Let's say we're looking at IWM, which is currently priced at 205.45. So what you would do to do the two options is you would first purchase or buy to open and a call option at the 205 strike price, which is at the money, and we'll just use this expiration March of 2026. This purchased call option would cost you approximately $2,110. Then you would sell an at the money put option, sell to open one put at the March 2026 expiration, which is the same as the call option, at the same strike price, 205, which you would then receive compensation for since you're selling the option. You would receive approximately $1,544. The net capital here would be approximately $566 as a net debit. So normally with a traditional covered call, you'd have to purchase 100 shares of IWM, which would cost approximately $20,545, which is the share price times 100 shares. But instead, we're looking at only $567.30. But you'll notice here, the max gain is unlimited, which is great, but also the max loss here is significant. The max loss assumes that potentially you have to buy 100 shares of IWM at this strike price, $20,500 would be your capital there, and assuming that IWM were to go to zero, which was unlikely, but could happen technically, would mean that you'd lose all $20,500 plus the capital to do the trade, $566. So a total of $21,066. So the big benefit here, very limited capital at the beginning of the trade. And if the market goes up, great. It's going to work out really well for you. But if the market goes down, you're on the hook for all the losses. This is as opposed to maybe the traditional deep in the money call option, where instead of doing this setup, you might say, I'm just going to purchase a call option at the, let's call it the 190 strike price, which is deep in the money, about a 70 delta, and that total capital here would be about 30.21, right? 30.21. So total capital here would be $3,021 approximately compared to 20,000, but still quite a bit more capital than that $567. But in this situation, the max gain is still unlimited and your max loss is only $3,021, the amount of capital at the start of the trade. So this is specifically what I did on January 27th, 2025. You'll notice here, if we go into my screenshots, we can see right here, I purchased right here an IWM call option at 225, the strike price. That was the at the money price. That cost me $2,516.68. And then I also sold a put option right here at the 225 strike price, and that I received as compensation $1,602.27. The net on that was $914.41 as a net debit. That was the initial capital in the trade. And throughout this time frame, as you can see right here, I was selling options every single day and collecting a small amount of income on a daily basis. $7, $6, $10, $14, $16 on a daily basis. Now, technically, if IWM during this time frame had gone up in value, then this would have been a great story about how successful this strategy can be. However, unfortunately, or maybe fortunately, since we have this learning lesson now to talk about, things didn't go great with IWM. Here's a look at Yahoo Finance. This is the price of IWM way up here at the time that I opened the trade, about 227, 226. And since then, I mean, things were going great until about February 18th, and then things fell off a cliff. We were at 227 here, and then down here as low as 197, currently around 204, 205. In all, the market dropped about 9.71%. So the call option that I had purchased had gone down significantly during that time, and the sold put option had gone up in value. Both of those were negative things that I didn't want to have happen. And the other big consequence here, the thing that, the big downside of running this strategy as an individual investor is whenever you sell a put option, you are creating an obligation to purchase 100 shares of that stock or ETF at the strike price at expiration. And because the price had gone from 225 down to about 195, 200, 205, I was technically in the money on that put option. And unless the market had dramatically turned around over the next, 6 months to a year, which is fairly possible, I was gonna have about $22,000 in capital set aside to purchase 100 shares of IWM. And here's why that's important. One of the big reasons why I implemented the Leaps Plus Income portfolio for 2025 was 3 main objectives. Grow with the market if it grows, be capital efficient, and have capital on the sidelines ready to reinvest at opportune times and prices if the market falls, and create income along the way. Now, this strategy has worked well for creating income, and if the market grows, my IWM YieldMax style trade would work out really well. But if the market falls, which it did over this time frame, about 50 days, then not only is the actual trade going down in value, but also I have this obligation where they're setting aside about $20,000 in capital to fulfill that put option if necessary, which limits how much capital I can then invest at opportune times. Which is why I made the decision to actually close the trade out despite the fact that I was going to incur a loss. And despite the fact that the trade could still turn around, right? Over the next 6 months to a year, it could be that IWM turns around and ends up at 240, 250, 260 in the future, in which case it would have worked out to just be patient. But in the meantime, I lose out on the opportunity potentially to invest more of my capital in other investments at opportune times. So as you can see here, here's how I laid out the key takeaways for this trade. I broke down the fact that I, again, had purchased or had initial capital of $914.41 in the trade, and that I closed it on March 17th. And the additional debit, how much additional capital I had to put into the trade to close it, was an additional $1,527.40. You can see it right here. I had the call option that I initially purchased, this call option, which was initially worth around, I think, $2,500, $2,600, I was able to sell, but I sold it for a loss and was only compensated $1,168. And then the put option that initially I sold for $1,500-ish, give or take, I had to buy back at $2,700. So in total, you can see here, an additional $1,527. The total capital lost on the trade, $2,441.81. The trade was open for 49 days, and during this time I did collect positive cash flow of $384.68. And as you can see, during this time, IWM dropped from about 226.50 to 204.50, or a drop of 9.71%. And if I had in fact owned 100 shares instead of doing this option strategy, I would have lost about $2,200 in capital if I had actually sold the shares. The key takeaway here is, and this is the really important part, the YieldMax style trade is still very capital efficient and would work really well if the markets go up in value. But, there's a big but here, the sold put option creates a collateral obligation, right? I have to buy 100 shares at the strike price if the market price is below my strike price at expiration. So if you have significant capital on hand, a lot of cash, then this is not a big deal, and you can hold out to see if the market reverses. But because I want to have significant cash set aside for purchasing or reinvesting at opportune times, it made more sense for me to close out this trade, learn from it, share what happened with you guys, but instead reorient that capital into a deep in the money call option instead, which has still the same unlimited growth opportunities, but also has capped on the loss based on the amount of value in the call option. So I actually was able to then put some capital into a fourth IWM deep in the money call option. So again, key takeaways here. The YieldMax style trade would be a great fit if you're investing or implementing this trade at market bottom. So if for some reason the market dropped 30, 40% and you want to initiate a new position because you think IWM, QQQ, SPY, any of these positions are going to go up in value in the future because we've dropped significantly, that would be a good time to put that trade on. But it still has the same inherent risks, which is you're selling a put option, which means you could have an obligation on your hand to purchase 100 shares when the markets continue to fall. If you're looking to run the poor man's covered call and you want to have a synthetic exposure instead of owning 100 shares, then for most average Joe investors out there, it's a better fit potentially to purchase a call option that's deep in the money on IWM, SPY, QQQ, whatever it is, rather than running the YieldMax style trade. Hopefully you found some value in this video, guys. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many of these comments as possible on the day I post a new video. And if you want access to the day-to-day changes in my portfolio, what I'm doing, you can always join the Average Joe Investor Patreon community. Tons of value there. Access to all my spreadsheets, access to the daily office hours with Joe, office hours that we do, an audio call where we talk through my portfolio live traded and go over any questions or concerns that you have. If you're interested, check out the link down in the description below. That's all I got for you guys. Have a great rest of your day, and thanks for watching.